Right, listen here. $13 billion vanished into thin air, and many people don't even know it happened. We're not talking about some crypto scam or .com disaster. This was America's biggest banking app, losing more money than entire countries' economies, whilst everyone was busy arguing about overdraft fees. June 12th, 2025, Chime Technologies goes public, pricing shares at $27 each. The financial media celebrates another fintech success story. $12 billion valuation, profitable quarters, millions of happy customers getting their paychecks 2 days early. But here's what nobody mentions. Just 4 years earlier, private investors had valued this exact same company at $25 billion. That means value simply evaporated before Chime even rang the opening bell. Real people made real decisions based on that peak valuation. Employees took stock options instead of higher salaries. Early investors calculated portfolios assuming Chime was worth $250 billion. Late-stage funds wrote massive checks believing they were buying the future of banking. Here's the mental part. Whilst losing paper value, the actual business kept growing. More users, more transactions, more revenue. The app still helped millions avoid overdraft fees and get early paycheck access. From a customer perspective, nothing changed. Yet somehow, the same company providing the same service was suddenly worth half as much. This creates one of modern business's most fascinating puzzles. How do you lose billions without actually losing anything? The answer reveals something profound about how startup valuations work. Or rather, how they don't work. What makes this particularly mental is that Chime actually succeeded at everything they set out to do, yet somehow became worth less money in the process. This is the tale of how two founders built a genuinely useful product that improved millions of lives, convinced Silicon Valley's smartest investors it was worth $25 billion, then discovered that sustainable businesses and sustainable valuations are completely different things. Now, before we dive into this tale of financial reality meeting startup fantasy, do us a favor and hit that subscribe button. You'll want to stick around for more stories about companies that prove the line between visionary genius and complete delusion is thinner than anyone realizes. How did two blokes from San Francisco convince the world that giving away banking for free was worth $25 billion? The answer starts with traditional banks becoming brilliant at extracting money from people who didn't have any. Chris Britt and Ryan King met in 2012 through a recruiter, just as major banks like Wells Fargo were eliminating free checking and doubling down on fee-heavy models. Britt had spent years at Green Dot and Visa, watching traditional banking systematically gouge low-income Americans with overdraft fees, monthly charges, and minimum balance requirements. Britt saw the opportunity. What if you built a bank that actually helped people instead of punishing them? The business model seemed impossible until they discovered interchange fees. It's quite brilliant when you think about it. Making money by helping customers spend their own money rather than charging them for the privilege of keeping it safe. Every debit card transaction generates 1% to 2% in merchant fees split between Visa and the card issuing bank. Traditional banks treat this as supplementary income whilst focusing on fees and lending. Britt realized interchange could be the primary revenue source if you generated enough transaction volume. The clever bit: to maximize interchange revenue, you need customers using debit cards frequently. Traditional banks discourage this by charging overdraft fees. Chime flipped this around by offering fee-free overdraft coverage, encouraging customers to use Chime cards for everything. The 2014 breakthrough came from the Dr. Phil show. Britt appeared explaining Chime's fee-free debit card, and the segment went viral. Suddenly, thousands who'd been gouged by traditional banking discovered an alternative that made sense. By 2015, Get Paid Early let customers access paychecks 2 days before traditional banks released funds. The 2017 Pay Anyone feature eliminated another fee. Banks loved charging for transfers, but the real game changer was 2019's Spot Me, fee-free overdraft protection up to $200. Traditional banks make billions from overdraft fees, averaging $35 per occurrence. Chime eliminated this entirely, betting loyal customers would generate more interchange fees than sporadic penalties. By 2020, Chime had 8 million users, processing billions in transactions. COVID-19 accelerated adoption as stimulus checks highlighted digital banking advantages. The business model was validated. Fee-free banking could be profitable through scale and engagement. But validation and valuation are different beasts, and the venture capital world was about to lose its mind over fintech opportunities. The year 2021 was when the financial world went mental about fintech, and Chime found itself at the center of a feeding frenzy that made shark attacks look civilized. Picture the scene. Interest rates near zero, stimulus money flooding the economy, everyone locked at home discovering digital banking. Venture capitalists threw money at anything with fin and tech in the name, convinced they were funding financial services that would make traditional banks look like dinosaurs. Chime's metrics were genuinely impressive. User growth had exploded to 12 million accounts, with 90% retention for direct deposit customers. Transaction volume approached $100 billion annually. Revenue climbed toward $1 billion, almost entirely from interchange fees scaling with engagement.
And CEO Chris, it's nice to see you this morning. How are you feeling about being a public company now?
It feels great. I'm so proud of the team and for getting us to this moment. And we had a great Q1. We grew our top line 37%. We grew our active member base by 23% year over year. And we also demonstrated great success on the operating leverage side with adjusted EBITDA of 3%. And we raised our expectations across the board. So really great execution and excited for the future.
The March 2021 funding round was where reality disconnected from reason. DST Global, General Atlantic, and others competed to write $750 million in checks, pushing valuation to $25 billion. That's over 40 times sales for a business that hadn't proven long-term profitability. To put this madness in perspective, JP Morgan Chase, with $130 billion annual revenue, was valued at roughly $450 billion. Chime's valuation meant investors thought a fee-free neobank was worth 1/18 of America's biggest traditional bank, despite having 200 times less revenue. The mathematics of this would make even the most optimistic estate agent blush with embarrassment. The justification was growth. Chime was adding millions of users, whilst traditional banks lost customers. Revenue per user climbed as customers consolidated financial lives around the fee-free platform. SpotMe had provided $5 billion in fee-free overdrafts, proving loyalty beyond typical banking relationships. But $25 billion was based on assumptions that would make optimistic entrepreneurs blush. It assumed 30% plus annual growth indefinitely. It assumed interchange rates would remain stable despite regulatory pressure. It assumed no serious competition from tech giants. It assumed addressable markets were unlimited. Most dangerously, it assumed growth metrics from pandemic conditions would continue forever. COVID-19 had accelerated digital adoption by years and created massive stimulus spending. These weren't normal conditions. They were extraordinary circumstances, artificially inflating fintech growth. The founders probably knew the valuation was aggressive, but who turns down $750 million? The money would fund expansion, development, and competitive responses. Besides, if you're going to be wrong about valuations, it's better to be wrong whilst sitting on $750 million in cash. If Chime could become primary bank for 50+ million Americans, $25 billion might be conservative. But markets have ways of humbling successful companies, and 2022 was about to deliver a reality check. If 2021 was when everyone lost their minds about fintech, 2022 was when the universe administered proper discipline to the technology sector. Chime, despite having a good business, was about to learn that profitable companies aren't immune to valuation corrections. The Federal Reserve started hiking rates aggressively after years near zero. Suddenly, money wasn't free, and investors could earn decent returns from government bonds instead of gambling on startups. When you can get 5% risk-free from Uncle Sam, paying 40 times revenue for a banking app, starts looking rather daft. The broader fintech sector collapsed first. Buy now, pay later companies saw valuations cut 85%. Digital processors faced regulatory scrutiny and slowing growth. Crypto businesses imploded as Bitcoin crashed from $69,000 to under $20,000. Investors who'd thrown money at financial technology became very selective. Chime's user growth decelerated as pandemic tailwinds faded. Stimulus money that boosted transaction volumes disappeared. People returned to offices and normal spending patterns. Extraordinary growth rates, justifying extraordinary valuations, were reverting to sustainable levels. Real problems began with regulatory scrutiny, revealing hypergrowth's hidden costs. The Consumer Financial Protection Bureau received 900+ complaints about sudden account closures, leaving customers locked out without explanations. The issue stemmed from aggressive fraud prevention algorithms. Processing $115 billion annually attracts criminals exploiting digital banking weaknesses. Chime systems flagged suspicious activity aggressively, sometimes freezing legitimate customers for minor irregularities. Senate Banking Committee Chair Sherrod Brown urged CFPB investigation into whether closure practices violated consumer protection laws. The optics were terrible. A bank marketed to low-income Americans was systematically locking those Americans out. In 2024, the regulatory hammer fell. CFPB imposed $5 million in penalties for failing to refund balances within 14 days. Additional fines included $3 million from California regulators and $200,000 from other states for misleadingly presenting as a bank without charters. Management faced impossible choices: maintain aggressive spending to justify valuations, or pivot toward profitability. Proving business models worked, user sentiment remained positive despite operational challenges. But positive sentiment doesn't translate to investor sentiment when valuation multiples compress. The writing was clear by late 2023. Chime needed to prove sustainability rather than growth, requiring acceptance of massive valuation haircuts. Acknowledging 2021's pricing was completely divorced from reality. By 2024, Chime chose reality over delusion. The transformation began with brutal honesty about what had gone wrong. Regulatory penalties weren't just compliance costs. They were wake-up calls about scaling without proper infrastructure. Crucially, Chime diversified beyond interchange fees to reduce dependence on single revenue streams regulators could eliminate overnight. March 2024's instant loans offered small dollar borrowing up to $500 at fixed 30% rates, better than payday lenders, whilst generating meaningful revenue. MyPay expanded early wage access to $500 based on verified employment. Chime Plus launched as premium membership bundling, higher savings yields, expanded SpotMe limits, and priority service for $12 monthly. This monetized engaged users whilst maintaining fee-free promises for basic services. Results were remarkable. Q1 2025 marked first profitable quarter with $13 million net income on $500 million revenue. Gross margins reached 88%, whilst transaction margins hit 67%, proving core business efficiency at scale. Revenue diversification worked. Interchange remained 72% of income, but lending, memberships, and services grew rapidly. Average revenue per user climbed to $251 annually, demonstrating monetization beyond transaction processing. The user base stabilized at 22 million total accounts, with 11 million using Chime as primary bank. These were engaged customers, averaging 55+ monthly transactions and maintaining substantial balances because they trusted fee-free promises. SpotMe had provided $43 billion in fee-free overdrafts since launch, covering 90 million transactions that would have generated $3+ billion in traditional bank fees. Customer retention remained above 90% for direct deposit users. Chime achieved profitability whilst maintaining their core mission, helping lower-income Americans avoid banking fees. They hadn't abandoned fee-free banking. They'd proven it could be sustainably profitable through scale, engagement, and intelligent expansion. Unlike most Silicon Valley fairy tales, this one actually had a business model that worked in the real world.
We'll be talking about it on CNBC. You're right here. I mean, it does help, I guess, but is there something else in terms of the audience or your potential addressable audience that they care whether you're a public company or not?
I think, as a company that is really a digital-first company, anything you can do to have more connections to the physical world is goodness.
Right.
Our aspiration is to be a generational brand that sets a new standard in banking, and of course we need to be a public company in order to do that.
Balance sheets were fortress strong, with $1 billion cash and virtually no debt. This provided flexibility for continued investment without dependence on external funding at unfavorable valuations. By late 2024, Chime confidentially filed IPO paperwork, signaling confidence they could justify public valuations based on business performance rather than growth projections. Investment bankers suggested realistic ranges of $12 to $15 billion based on revenue multiples for comparable profitable financial services. The path was clear: demonstrate consistent profitability, maintain healthy growth, prove compliance, and educate public investors why sustainable neobanking deserved premium valuations, even at lower absolute numbers than peak private pricing. June 12, 2025, arrived with anticipation that makes or breaks Silicon Valley reputations. Chime's IPO would either validate their transformation or prove even profitable. Neobanks couldn't justify massive venture valuations. The pricing process managed expectations masterfully. Lead underwriters initially suggested $24 to $26 per share for $11 to $12 billion valuations. Strong institutional demand pushed final pricing to $27 per share, establishing $12 billion market capitalization. $12 billion. In 2021, private investors had valued Chime at $25 billion. The largest fintech valuation correction in history had occurred without fraud or business failure. Opening day told the real story. Shares immediately surged to $43, 59% first day pop, proving public investors were genuinely excited about profitable neobanking. Closing around $37 million represented 37% gains and delivered 2025's strongest fintech debut. Financial metrics justifying enthusiasm were undeniable. Chime approached $2 billion annual revenue with 30% growth. First profitable quarters proved sustainable unit economics. Customer engagement remained extraordinarily high, with 90% plus retention and $251 average revenue per user. The valuation correction wasn't really a loss. It was markets finally pricing Chime on business fundamentals rather than speculative projections. 2021 valuation assumed pandemic-level growth rates indefinitely, whilst expanding internationally and capturing ever larger market share. 2025 valuation reflected reality. Chime was America's largest, most successful neobank, serving 11 million primary customers with superior products. But it wasn't becoming the world's dominant financial institution overnight. What had Chime lost? The fantasy that venture capital could assign arbitrary valuations based on growth rates defying economic gravity. The delusion that user acquisition could accelerate forever without hitting natural limits. The assumption that regulatory compliance was optional for fast-growing fintech. What had Chime gained? Sustainable profitability, proving fee-free banking worked at scale. Regulatory credibility through compliance investments. Product diversification, reducing interchange dependence. Public market access, providing permanent capital and liquidity.
Chime is going to begin trading today. This after it priced its IPO. It was above the expected range. It priced at $27 a share. I sat down with the company's CEO, Chris Britt, last night. We talked about its path to the public markets. The online banking firm was once valued as high as $25 billion. That was in the private markets back in 2021, around a capital raise at the time.
The broader lesson extends beyond Chime to entire venture ecosystems. Late-stage valuations during 2020 to 2021 were based on extrapolating temporary pandemic conditions indefinitely. Companies raising at 50x plus revenue multiples were never actually worth those prices. They were benefiting from bubbles destined to burst. For employees joining during the peak, IPO provided liquidity at reasonable valuations, reflecting actual performance. For early investors believing in fee-free banking before it was fashionable, IPO delivered substantial returns, even at reduced valuations. For 22 million Chime users wanting banking that didn't exploit them, valuation corrections were completely irrelevant. Their money remained safe. Fees eliminated, financial lives improved by products traditional banks refused to offer. Chime's journey from $25 billion unicorn to $12 billion public company proves sustainable value creation matters more than peak valuations. The correction wasn't really a loss. It was markets finally pricing the company on reality rather than hype. Right. You'll want to stick around for more stories of these companies that'll have you wondering where we've all gone wrong with our lives. Boah, humbug!